Last week I released a video explaining the process that I go through when I'm calculating the intrinsic value and buy price of a business, and a lot of you provided some feedback that you wanted to see a real life example of going through this process using a real company. So that is exactly what we're going to go through in today's video. I'm going to use the company Facebook and show you exactly the process that I go through when I'm calculating the intrinsic value and buy price of a business. So if you do enjoy today's video, make sure you let me know by hitting that subscribe button if you haven't already, or just leaving a like or a comment down below. But for now, let's jump into it. So the first step in calculating the intrinsic value and buy price of a business is to calculate what the cash flow for owners figure was in the previous year. Now, typically I will use the annual number, so either the 2018 number or the 2019 number if those results are out. But since Facebook has 3 quarters, quarters 1, 2, and 3 of their 2019 results out, I'm actually going to be calculating it based on the last 4 quarters, which is Q1, 2, 3 of 2019 and Q4 of 2018. I won't be doing a full explanation of what cash flow for owners is in this video because I actually have a video on my channel dedicated to talking about cash flow for owners, so I will leave a link to that and any other videos that I reference in this video down in the description below for you to check out, either by pausing the video now and going and watching it, or you can watch it afterwards. But essentially, just to give you the headline, cash flow for owners is calculated as operating cash flow minus maintenance capital expenditure. Okay, so since we are calculating cash flow for owners in the previous 4 quarters, we're going to have to do a little bit more work in order to calculate this number. If we were just using the 2018 number, for example, it's really simple. We just need the net cash provided by operating activities, which is here. We then have the capital expenditure number, which is here, purchase of property and equipment, and then we would need to estimate a proportion of that property and equipment, which is maintenance, because maintenance capex is a proportion of the total capex number. So that would be super easy, but since we are trying to calculate this for the past 12 months, there is going to be a little bit more work involved. So to start off with, we're going to start on the 3rd quarter financial statements that were released, the quarterly report from Facebook. So I head over to Facebook Investor Relations, and down here in the SEC filings, or if you head over to the quarterly earnings, you can see that there is a Form 10Q, and that is the SEC filing where we are going to be able to find all of the financial statements. So that is this report here. And I've just done a quick search for statement of cash flows so that I can find the cash flow statement here. And here you can see that we have net cash provided by operating activities. And then we also have purchase of property and equipment. And this purchase of property and equipment is the total capital expenditure number. Now, another thing you will notice is that these figures are for the 9 months ending September 30. So this is the last 3 quarters, okay? So remember, when we're trying to calculate the previous 4 quarters, of course, as a part of that, we need Q1, 2, and 3 of 2019. And that is what this figure is going to tell us here. So we then need, Q1 to 3 for operating cash flow is here, $27.23 billion. And then total capex for Q1 to 3 is $11 billion here. So let's write these numbers down so we can keep track. So we've got op cash flow for Q1 to 3, 19. And then we have total capex for Q1 to 3, 2019 of $11 billion. And then, of course, because what we need is we need Q1 to 3 of 2019 plus Q4 of 18, right? Because that's the other quarter. So we're going to do a little bit of maths here. And what we're going to do is we're going to take the total number from 2018 and we're going to subtract this number here, which will be the first 3 quarters of 18. So if we have the full year of 18 and we subtract Q1 to 3, what are we left with? We're left with Q4 of 18. So that's how we're going to get that last quarter that we require. So again, we're going to do a little bit of maths and we're going to be calculating operating cash flow for Q4 of 2018. And this is going to be equal to the total operating cash flow number, which is 29.3. So 29.3. And we're going to subtract the first 3 quarters of 18, which is here, 21.7, which is 7.6. So we've got 7.6, and then we need to calculate the total CapEx number for the exact same period. So again, taking the total CapEx number from 2018, and we're subtracting the first 3 quarters of 2018 in terms of CapEx, which is 9.6, which leaves us with 4.3. So the next step is that we need to estimate the proportion of total CapEx, which is going to be maintenance. And there are many ways that you can go about this. And again, I want to create a video in the future going through some of the methods that I use. But in the interest of time, I'm just going to show you what my calculation was, which is that 50% of total CapEx is maintenance and 50% is growth. So that would mean that half of this total CapEx number is maintenance, 5.5, and half of this number is also maintenance, which is 2.2. And then it is simply a matter of doing some simple addition. So we've got operating cash flow for the past 12 months, which is $27.2 billion plus the 7.6 from the fourth quarter of 2018, which gives us $34.8 billion. And then in terms of maintenance CapEx, we've got 5.5 plus 2.2, which gives us a total of $7.7 billion in maintenance CapEx for the past 12 months. And then, of course, to do cash flow for owners, we subtract one from the other, which is 34.8 minus 7.7, which equals $27.1 billion in cash flow for owners in the past 12 months. Step number 2 in the process of calculating the intrinsic value and buy price of a business is to estimate the future growth rates of this business. How quickly is that cash flow for owners figure from the past 4 quarters going to grow at into the future over the next 10 years? Now, Facebook's growth over the past 10 years has been outstanding, but you may notice that it has been slowing over time. And because Facebook's growth is slowing over time, we need to be very careful when we're calculating our future growth rates. We can't use their 10-year average growth rate because that is actually the biggest growth rate that they've had over the past 10 years. It's been progressively getting slower and slower. So we need to have a look at the industry trends. We need to look at the trend of Facebook's growth itself and see where we can expect their growth to grow at in the future over the next 10 years. Finding free and available industry data for businesses can be very difficult, but if you do enough digging, then you can usually find the data that you're looking for. And for Facebook, we're looking and focusing in on the social media advertising industry. That's a part of the broader digital advertising industry. And for this, I got information from Deus Aegis, which is a research firm that does this kind of research, and they found that they are expecting the social media advertising industry to slow their growth to about 16.7% in the next year. And that's a dramatic slowdown from the 27% that they achieved, that the industry achieved, I should say, in 2018. So again, this is in line with what Facebook has been showing over the past 10 years. Their growth has been slowing down, and this has probably been driven by the fact that the industry growth is also slowing down. And so Facebook's growth has also been slowing down, as has the industry. However, Facebook has continued to grow at a faster pace than the industry, even as it slows down, as Facebook in the past couple of years, 2018 and 19, has still been growing their revenues at somewhere between 20 and 40% per year. So essentially what this means is that in our estimations, we could assume that the industry is going to continue to slow, but that Facebook, as a big component of that industry with its competitive advantages, is going to continue to grow at a faster pace than the industry. So for that reason, I have picked future growth rates for the next 10 years for Facebook of between 10 and 18%. And one other thing that I want to mention is that it is always a smart idea to pick a range of growth rates. A range that includes, in the middle, growth rates that you expect to happen, at the bottom, growth rates that you think are very, very achievable by the company, and at the top, that 18% that we're using for Facebook, for example, a growth rate that you think is not likely going to happen, but is a possible outcome. And that way you capture a range at at which intrinsic value likely sits, and a range at which you can start buying into the company. Now, once we have our starting cash flow for owners figure, and we have the growth rates that we can enter into the calculator, the discounted cash flow calculator in my spreadsheet will calculate all of the future cash flows for the next 10 years for us. And within that calculation is also what's called a terminal value, which is 10 times the 10th year cash flow number, which is a little bit confusing, but essentially what the theory is behind that terminal value is that we're assuming that Facebook isn't just going to go away and produce no cash flows after the 10th year. We are assuming that their cash flows stop growing, but continue to produce the same amount of cash flow for another 10 years, ultimately capturing a 20-year period for this company in terms of cash flows. Now, terminal value is an entire topic in of itself, and it deserves further explanation, as I know that what I just said probably makes no sense to a lot of people, and there's probably a lot of questions people are asking. Why not calculate it out to 30 years? Why not assume a growth rate after the 10th year from 10 to 20? So all of those questions and everything that I understand about terminal value and how I use it will be explained in a future video coming up, so you can look forward to that. And if it's available, then I'll leave a link to it down in the description below. Now, the next step in the intrinsic value calculations, once we have our starting cash flow of 27.1 billion and our growth rates ranging from 10% to 18%, is we need to estimate the discount rates. Now, for intrinsic value, we want to use the risk-free rate that an investor can achieve. Now, in theory, this doesn't exist. There's no such thing as completely risk-free. However, in practice, we use the 10-year US Treasury yield because the US government has never defaulted and has never paid an investor for an investment in US Treasury bills. So we are going to use this as our risk-free alternative. At the time of recording this, that is 1.8%. So that is what we're going to enter in for the risk-free calculation. And then in terms of calculating the buy price of the business for the whole business and per share, we want to use our own personal target return. What return are we trying to achieve? And this return for me is always 22%. You might be wondering why I use 22%. Well, the reason why I use 22% is because 22% compounded over 10 years is approximately 8 times our investments. It's a little bit under 8 times our initial investment. And what I'm actually trying to achieve is 15. So I'm trying to make 15 over 10 years, which is 4 times our initial investment. So what happens is when I use a 22% return and 8 times my money, or just under 8 times my money over the next 10 years, I am allowing for a 50%, a huge 50% margin for errors in our valuation. So even if our growth rates are off by 50%, we're completely wrong, I am still going to make my 15% return if I abide by these buy prices. So just to clarify that one more time, I want to make 15% consistently over the long term, but I aim for 22 so that if I am wrong in my assumptions, I am likely still going to make a high return over the long term. And the last step when calculating the intrinsic value and the buy price of a business, and ultimately when you're investing, is to just have patience and discipline. So once you have done everything in this video, you have calculated the intrinsic value and buy price of the business within a range based on the growth rates that you've assumed for the particular business. And now it is just a matter of having the discipline to wait for the business to fall within that range so that you are completely confident or have high confidence that you are going to at least make that 15% per year. And of course, we have that buffer for errors in our valuation if the company does end up underperforming what we expected. And again, just to reiterate, this is just an example. This is certainly not advice in regards to Facebook stock. Some people may, from their calculations, they may find that they think Facebook will grow at a slower rate. Some people might think it can grow at a faster rate over the next 10 years. But whatever your calculations are, you should reach your own conclusions. And while you can use the process in this video, I certainly don't suggest that you go out and invest invest in Facebook stock based off the specific calculations that I've shown in this video. So for those people who were seeking further explanation after the previous video, I hope this sort of helped to show a little bit more into the process and dive a little bit deeper and maybe answer some of the further questions that you had and queries that you had and that sort of thing. But if you still have further questions, problems, things that are coming up, or just other topics that you want me to talk about and dive into, then please, again, leave me feedback, whether it's positive or negative. I love getting feedback from you guys because it always helps me to improve the content that I'm providing and the way that I'm presenting it and all of that sort of thing. So again, if you enjoyed the video and you're new around here and you want to see more content like this, then you can expect plenty more content like this in the future, and that I would suggest that you go ahead and hit the subscribe button or leave a comment and leave a like. All of that's good stuff. But yeah, I hope you guys enjoyed this one, and I'll see you in the next video.